Good afternoon, learners. You are welcome to our today's online learning, and the subject remains business studies for week 3. Our topic says journals, and the class is basic 7. Our objectives are the things that we should be able to attempt or do at the end of this class. So, by the end of this class, the students will be able to explain the meaning of journals, 2, identify the classification of journals, and 3, mention the uses/importance of journals. But before we go into the topic proper, remember that last class we have the topic that says double entry bookkeeping. That was our topic for last class. And we said double entry bookkeeping system is a fundamental principle of bookkeeping in which every transaction, okay, must have effect on two sides, which is the debit side and on the credit sides. That means for every transaction you make, the posting will be on both sides. That's the debit and the credit side. And that's why we have the popular saying that for every debit entry, there must be a corresponding credit entry. Now, having said that, we were given an assignment in the last class, and the assignment is this illustration. Jaguar Generator Company has a cash balance of 15,000 naira as at January 2019. From the following transaction, it says open all the necessary ledger accounts. And we have January 3rd paid wages, January 4th paid electricity bill, 1,000, January 7th we paid insurance, 1,400, and January 10th we paid rent of 400 naira. So having said that, we go to the treatment and the posting. Okay, so the first step we have to take is that we have to construct our cash book. As we can see from all those transactions now illustration, they are all cash. Paid wages in cash, we paid electricity bill in cash, we paid insurance, we paid rent. Okay, so we have to open our cash book first of all. And mind you, we say the double entry principle has two major principles. It says you credit the giver and you debit the receiver. You credit the giver and debit the receiver. Now, Jaguar Company has 15,000 naira, okay, to start a business. Now, we assume that this money is not his own personal money because a business is an entity of its own, okay? So it is differentiated from the proprietor's personal money. So the proprietor borrows the business the money, which business will pay back. So in that case, we say Jaguar Company, which is a business, has a capital of 15,000 naira. Don't be surprised that in our illustration, there was nothing like capital and nothing like on the 1st of January. But because we have seen there that as of January, you have 15,000 naira, we know that automatically that's the capital because without capital, you cannot start a business. Okay, so the business has received 15,000 naira. That's Jaguar Company have received 15,000 naira. Mind you, we say you debit the receiver and you credit the giver. That's the major double entry principle. So here, Jaguar Company has been debited, okay, because he is the receiver of 15,000 naira borrowed maybe from the proprietor as a capital to start up the business. So from there, we start doing the expenses. And on the 3rd of January, we say the expenses was made. He paid wages of 3,000 naira. We say on the 4th, he paid electricity bill of 1,000 naira. On the 7th, he paid insurance of 1,400. On the 10th, he paid rent of 400 naira. Now, listen very well. Why are these money or values on the credit side? It's because of that same principle we did. He said we should credit, okay, the giver, credit the giver, okay, and debit the receiver. So in this case, okay, money is going out, okay, So the receive the giver here, okay, is the credit side, because the credit side says the given account should be credited. So the wages here is the account that is given to. Okay, so it has a value of 3,000 naira. Electricity as well is receiving value of 4,000 naira. So money is going out from Jaguar. That's why it is being credited. Okay, on the 4th, electricity of 1,000. On the 7th, insurance of 1,004. On the 10th, rent of 400 naira. Having said that, we also have January 31 balance carried down. Why is this stated there? Because in the question, there was nothing like 31st and there was nothing like balance carried down. So at this stage, we have to know that your balance carried down is a balancing figure that is meant to make the credit side and the debit side to be equal. Because if one place is bigger than the other, we cannot have our total being equal. Okay, so for the sake of making our total to be equal, we've carried balance carried down is 9,200. How? When you add wages, electricity, insurance, and rent together, you have to subtract it from 15,000 naira capital. What will remain in the hand of Jaguar, okay, is 9,200. So having said that, by the time you sum up everything, on the credit side, you have 15,000. Then on the debit side, you just carry the value down. Then we see have February 1st balance brought down. This is showing that for the next period, which is February, Jaguar Company will have in its hand 9,200 naira to begin expenses again for the next period. So having said that, let's quickly go and form the ledger, which is the main question. So please, I believe you can see this, though it's somehow tiny, but please, we can see that in the posting there, wages account, okay, wages account, we have on the debit side 3,000 naira. We go to electricity account, we have there 1,000 naira. We go to the rent insurance account, we have 1,400. We go to the rent, we have on the debit side 400 naira. Then we go to the capital account and we have on the credit side 15,000 naira. So you can see that the principle of double entry have been fulfilled here, because in the cash book we see that whatever is on the credit side, okay, in the ledger it is related to the debit side. Don't forget, we say for every debit entry there will be a corresponding credit entry. Therefore, in this case, for every credit entry that we have here on the ledger, we have the corresponding debit entry. So that's been as it may, our double entry principle have been fulfilled. Okay, so having said that, we have to go into the topic proper for today, and we say source definition of journals simply means, okay, earlier we have discussed about source documents, and we say it is the original entry of business transactions when it took place initially. Then we see, apart from the source document, there are other business documents in which business transactions are later transferred into. For instance, we have the journals, we have the ledger, their balance sheet, and so on and so forth. So from the source document, we have to take the transactions into the journals. Okay, journals is the next step in the accounting processes. So we want to look at journals definition this morning. Okay, mind you, it can be called journals, it can be called subsidiary books, or book of prime entry. Having said that, what is journal? The journal, apart from the source document, is another book of original entry where the details of financial transactions are first recorded and later it will be transferred to the ledger. And that is why it is also called book of original entry. Okay, so what we're saying here is that source documents, we have them like the receipt, the invoice, the cash register, and all that. Okay, after that, from the source documents, we have to transfer to the journal. But the journal is also another book of original entry, okay, where transactions are being posted, and from there can be transferred, okay, to other books of accounting. So apart from the source document, the journal too is a book of original entry. That's what we mean here, okay. So having said that, we want to look quickly at the uses or importance of journals. So we say it is used to open and close entries. It is used to correct errors. It is used to record purchases and sales of fixed assets, and it's also used to record money or items taken from the business by the owner or proprietor of the business for private use or purpose. Okay, now let's look at the classification of journals. Now, journals have two broad categories. We have one, the special journals, and the second one is the general journal. So the general journal is used to record in a small business enterprise, okay, where they don't have to open so many books. Everything is recorded in the general ledger. But when it comes to a big business firm, okay, we use what they call the special journals. And special journals have different books under them. And we have the sales day journal or book, purchase day journal, we have the return inward journal, and we have the returns outward journal. We also have the cash book. Cash book is also a journal. We also have the cash book, and we have the journal proper. But in this class, we'll be able to look at the apart from the cash book, which records all cash transactions. We have to look at the four other vital special journals, okay, which are used for transactions. And these transactions are not cash transactions. For instance, we have the sales day journal or book. We say this is a type of journal used to record all goods sold on credit. So you can see this cannot come into the cash because goods are sold on credit. That's why we have to have a special book for that. It's called the sales day journal. The purchase day journal is used to record all goods bought on credit. When we buy goods on credit from our suppliers, okay, the supplier will record that transaction in the purchase day book. Now, the returns inwards journal or book is used for recording all goods sold but are returned to the seller due to a defect. That means if we sell goods, okay, the buyers may return them due to the defects on them. So when they return it, it will be recorded in the returns inward journal. It's the same thing. We as the sellers, we also return goods to suppliers based on defects, okay, or maybe it is substandard. We have to return those goods back because keeping it is of no good or of no use because you will not be able to sell them, and if you manage to do it, to be returned when they realize that it is defected. So you have to return it. So when you turn to your supplier, he has to record that in the returns outward journal. So as mind you, I say aside these four, we also have the cash book, which record all cash transactions, and we have the journal proper. Journal proper takes into consideration all the things that cannot fall into these other classes of special journals. Okay, for instance, when the proprietor of the business takes goods from the business for personal or private use, it will come into the journal proper. Or when there are some errors to be corrected, it will be done in the journal proper. So, having said that, today we've been able to look at the topic that says journals, okay? And I expect us to be able to attempt this. Vividly define journal. We can define that. We say it's another book of original entry apart from the source documents used to record transactions from which we later post to other books, okay, of accounts. We say list two functions of a journal, which we have seen as part of as a use of the importance of journals. We also say explain three different classes of journals. Three different classes of journals. Yeah, we're talking about the special journals. Give us three different ones under the special journals. Okay, which I've already seen in the previous slide. Then for next week, our assignment will be dash is a document issued when there is a return inward by the buyer. Secondly, dash is a document in which the goods bought on credit by a seller from the manufacturer is recorded. And thirdly, dash is the cash book. Sorry, is the cash book a source document or a journal? We have to explain that, giving reasons why we are choosing whether it's a source document or a journal, and you will send it to my WhatsApp number, or to the send to the general group uh, WhatsApp. Okay, and thank you very much. I remain Mr. Shofoluwe Olisa, your business study teacher. Stay safe until we meet in the next class. Thank you.